Welcome to the Winthrop Wealth second quarter 2023 market review and outlook. I'm Andrew Murphy, Co-Chief Investment Officer. After a difficult year last year, most major asset classes are performing well in 2023. The S&P 500 entered a new bull market, which is an increase of over 20% from a bear market low. And while the U.S. bond market declined in the second quarter, it is still in positive territory for the year. Today I'll review the U.S. equity and fixed income markets. I'll discuss the economy, inflation, and Fed policy, and then I'll review our short and long-term outlooks as we move forward. Please visit our website at winthropwealth.com to view the full written version. At Winthrop Wealth, we follow a total net worth approach, which combines both comprehensive financial planning and investment management. We believe the right mindset, paired with a comprehensive financial plan and a thorough investment process, can provide confidence in pursuing your long-term financial goals. We hope that you and your families are having a great start to the summer, and we look forward to speaking with you soon. The market rally continued in the second quarter as the S&P 500 increased by 8.7% in the period. After gaining 7.5% in the first quarter, the index is now higher by 16.9% in 2023, for the second best overall start to a calendar year in the last 25 years. The S&P also officially entered a new bull market, which is an increase of 20% from a bear market low. With hindsight, the latest bear market officially lasted from January 3rd to October 12th, 2022, with a total decline of 24.5%. And since the bear market bottom, the index is higher by about 26% and is about 5% below its all-time high. The S&P 500 increase has been narrow this year, which means only a handful of stocks are responsible for the overall performance of the index. The top 7 companies in the S&P, which are mainly considered growth stocks, have performed exceptionally well. And meanwhile, about 20% of stocks are negative for the year, with only about 30% outperforming the index. As a reminder, rather than make risky concentrated bets on single stocks or asset classes, we prefer to construct diversified portfolios and tilt toward the areas we feel will provide the most potential benefit. The Bloomberg Barclays U.S. Aggregate Bond Index, or the AGG, decreased by 0.8% in the second quarter, as the 10-year Treasury yield increased from 3.47% to 3.84% in the period. As a reminder, bond prices move inversely to interest rates and credit spreads. Despite the negative quarter, the bond market is higher by 2.1% in 2023. The index is still trying to find its footing after 2022's minus 13% was the worst calendar year since inception of the index in 1976. Most of the damage in the bond market in 2022 happened in the first half of the year, as interest rates moved higher in nearly a straight line. We've continuously stated that all else equal, the fixed income markets need yields to stabilize rather than decrease to achieve positive returns. And we'll point out that the bond market's return has been positive over the previous year. From June 15, 2022 through the end of the quarter, the 10-year Treasury yield increased from 3.47% to 3.84%. And that's the exact same increase in the 10-year yield as in the last quarter. Yet the AGG's return from June 15th last year to now was 1.7%, while the index again declined by 0.8% in the second quarter. And that positive return, despite the same increase in interest rates, was because there was more time to receive coupon payments and for the underlying bond prices to appreciate toward par value. We'll also continue to highlight that the bond market's yield to maturity, or the estimated rate of return an investor can expect from a bond if purchased today, and assuming there are no defaults, ended the quarter at 4.8%, the highest level since 2008. And please see our Bond Primer client question, where we detail bond mechanics, characteristics, types, risks, and historical returns. The United States economy continues to meander along and send mixed signals about its future path. Manufacturing data, economic indicators, consumer spending, and the housing market have all weakened and exhibited signs of a recession. We are encouraged that several inflation readings are off peak levels and have returned to normalized ranges. Although the Fed's preferred measure, core PCE inflation, is currently at 4.6% and remains well above the 2% target. Meanwhile, the strength of the economy currently lies with the labor market, as the unemployment rate of 3.7% is close to a 50-year low. The service sector, including retail, leisure and hospitality, and healthcare, continues to add employees in search for new workers. And while the economy has slowed considerably since 2021, it has still been able to avoid the technical definition of a recession for now. As the labor market continues to exceed expectations, the forecasts for the start of a recession keep getting pushed back by a few months. Even the Fed seems genuinely surprised at the strength of the economy, despite several bank failures earlier this year, and despite the FOMC raising interest rates by 5% since March of 2022. The Fed's view seems to be, if the economy is still performing well and core PCE inflation remains elevated, why not raise rates again? And with this framework, the Fed is now assuming 2 more 25 basis point rate hikes this year. However, as past years have demonstrated, Fed forecasts are only a snapshot in time and they can change quickly. We suspect that upcoming inflation readings will drive future Fed policy. The market rally since October was driven by evidence of disinflation, the economy, labor market, and corporate earnings holding up better than expected, and the perceived benefit that artificial intelligence will have on profits and productivity. Despite the strong performance over the past several months, significant market and economic risks remain, and we continue to separate our outlook into short and long-term periods. We're turning cautious in the near term as the S&P 500, currently at 4450, recently broke out of its 14-month trading range of 3600 to 4300. In our opinion, the fundamentals of the stock market do not warrant a recovery back to all-time highs yet. Valuations are stretched, especially given the current level of interest rates, and while earnings have come in better than expected, they would face downside risk if the economy began to stumble. And furthermore, the Fed may very well continue to raise rates. Adding it all up, we would expect some consolidation with a move back into the upper end of the recent trading range as a probable outcome. If the market were to break toward the bottom end of its trading range, our short-term view would turn more positive, and we would look to add equities in actively managed portfolios. If the S&P were to continue toward all-time highs, our short-term view would turn increasingly cautious, and we would begin trimming equities. For the long term, a key tenet to our investment philosophy is to maintain a long-term viewpoint, as markets can be incredibly volatile over short time periods. As the market sold off last year, we reminded clients that difficult periods create opportunities for long-term investors, and while market weakness may return, staying invested or adding to existing holdings throughout 2022 looks like a great decision right now. The stock market has historically increased over time, as successful corporations have been able to figure out ways to generate profits through advances in innovation and productivity. In our view, investors with a globally diversified portfolio and a long-term horizon should remain optimistic. And going forward, we view any short-term volatility as an opportunity to make lemonade out of lemons by tax loss harvesting, repositioning and rebalancing portfolios, and selectively put money to work for clients that have recently made contributions to their accounts. And we will continue to leverage our investment philosophy and process and rely on the value of time, diversification, and the power of compounding. Thank you for watching today's video. Please visit our website at winthropwealth.com to view all of our market commentaries, including our latest client question of the month pieces on the power of compounding and our principles for long-term investing.